Hey guys, welcome to kind of a blustery, kind of chilly day here in Austin. Kind of just been raining all day. Got woken up by a thunderstorm about 7 o'clock this morning, lightning, thunder, everything. All right, guys, let's look at these funds, IQQQ and ISPY. How does that sound? I did a fund of the week show yesterday. I think the rain's starting again. It is. It's been raining off and on all day. There's Jackson back there. He's hanging with me. Not a very fun day to be a dog. Um, all right. I did my fund of the week yesterday and I made IQQQ fund of the week. So I want to do a video today because I've never actually looked into it and just see some of the basic facts about it. So IQQQ hasn't even had a dividend yet. It's only an $18 million fund. ISPY, on the other hand, is 81 million, which is still pretty small. You know, I mean, expense ratio is very reasonable, 0.5%. You know, I did look at ISPY a few months ago and I expressed reservations about it then at that time, but I'm taking another look at it today to see if there's anything I got, maybe that I got wrong. All right, so this is a ProShares. Now, ProShares, $66 billion company, 12th biggest ETF issuer in the United States. These guys, their biggest fund is actually TQQQ, I believe. Is that right? Yeah, it is. Triple leverage NASDAQ. So they have some other really good funds, some really good funds on their list. But anyway, these ones we're talking about today are two of the smaller ones on their list. All right. So if we took, like I said, IQQQ has not had a dividend yet. It probably will have one this month. They'll declare on May 1st, it looks like. Based on past history. ISPY has been paying 31 cents a month. You extrapolate that over a year, it comes to about a 9% dividend. Their first dividend was bigger because it was for like a month and a half. Their fund was issued and they didn't have a dividend for a long time. Kind of the same thing that's happened to IQQQ. All right, let's look at the prospectus and the internet and let's see what all is out there on this fund. Okay. All right, so here's all the fund families. I was enjoying looking at this. BlackRock's biggest fund is IVV. Vanguard's is VU. State Street's is SPY. $500 billion, I think, is SPY has under management. Yeah, 500 billion. That's $500 billion, right? Wow. In any event, ProShares, you know, let's look at their lineup here. Yeah, TQQQ was 19 billion. Now, a lot of that has come from the fact that it's leveraged and the market's been going up. This fund would lose a lot of assets under management real quick if the market reversed. But this is kind of like the perfect storm for triple leverage NASDAQ the past, you know, since October, let's just say. Well, outside of the past 2 weeks, I guess. But from October until 2 weeks ago, it has been an incredible time to be leveraged NASDAQ. So, but who knows? We turned around and started going up again midweek this week. So maybe the worst is over. In any event, they also have a dividend aristocrat one. They also have these other leveraged offers. Okay, so the fund itself. ProShares NASDAQ High Income ETF seeks investment results before fees and expenses that track the performance of the NASDAQ 100 daily covered call index, which I cannot find that index. I don't know where that is. You heard me ask Jay, is there a daily benchmark? Meaning an index benchmark, same thing. If there's a benchmark, they turn it into an index so you can follow it. You know, they describe what it does in here, but I think there is a daily benchmark insofar as the way they do it, because they make an agreement with the bank. And so, you know, that's what I figured out is a lot of the stuff I didn't understand, I think, was because of a lot of the stuff I did not understand at first was because of the swap. But after I watched Panda's video a couple of times, I think I understand it better. Okay, so I have some other stuff to show you guys. So here's the S&P one, and it's all the same stuff. Now, they show the holdings, and the holdings are your standard NASDAQ. They just replicate the NASDAQ exactly, although they add about 14% is one, well, not one, but is they 14% of their net asset value is futures. So that's a boost on the upside. It would also be a boost on the downside, but that gives them a little extra return over and above, because yes, the covered call strategy, even though it is way out of the money, it does cap the upside. To the extent that it does cap the upside, the futures, the long futures position undoes that or mitigates that to a large extent. So they both do that. So if you look right here, okay, so let's look over the 30 days and see how these funds are done. They should have done well, except though over the past 30 days, a lot of it was on the downside. So I don't know. Let's just see. Let's see what we have. All right, 30-day index. Well, I mean, I have the IQQQ down 2.9, and whereas the QQQ is down 3.2. SPYs are down 2.8, or the ISPY was only down 0.94. So both respectable. It's very respectable as far as that goes. So the option these guys sell is right here. They talk about what they do. They don't actually sell the option, but the position they have on has the effect of 100% overwrite, 100% of net assets. And with the option sold at the 51.60 strike. So I have my tasty trade open. The only problem I had with it is this. The gold line is at the money. This is for April 29th. This is for tomorrow. All right. So the first blue line is one standard deviation up. That's above 51.20. So more than a 20-point move. So, but then if we move another 20 points, a 40-point move, which is a 2% move, which doesn't happen often, that's a 2 standard deviation move. Well, the option they sold is above 2 standard deviations, another 3 strikes at the 51.60 level. It's just bid at 20, it's asked to 40. Me being a private trader, I wouldn't be interested in that. I would want to sell one closer to the money, even though it capped my upside more, because I think you're trying to balance upside and income is also buffer. And I think when you go super far out of the money, you are unbalanced as far as you don't get as much income as I think you need, and you don't get as much buffer. Now, however, they do this in a swap, and my theory is the swap is based on the total return of that call sold on their assets. So the total return includes upside. Now, it doesn't include all the upside, but somehow the bank has it worked out. And so I think the 9% that they pay comes from this 30 cents. Plus, I think you also get a little bit of the upside from the swap. I think the swap pays more than just this, because I did the math on just this, and on just this is not very much. Look at this. Okay, because 30 cents, let's compare this to JEPY. JEPY sells the 65 delta put. So we go to the other side, but it's equivalent. You can go from one side to the other, and there's parity between puts and calls. Here's the 62 delta. So if they sold that, so the the JEPY sells a $17 option and pays like a 40% dividend. This fund is only selling a 30-cent option. So how big of a dividend do you think they could afford to pay? Well, based on that math, they could only afford to pay about a 1 or 2% dividend. But they aren't just paying the extrinsic like Jay does. They're paying part of the total return, and that's coming through to them in the swap, which we don't know because it's a private transaction between them and a bank. But that is my theory on how that works. All right. So let's look at this now. All right. So these option selling strategies puts you in a big advantage. These are the caveats, but these strategies doesn't mean that when you do these, you win every time. And it also doesn't mean that just because covered calls, are money makers and, and you have an advantage, it doesn't mean that's the best thing to do at any given time for your account, because there's a jillion, other different factors. There's a jillion different ways to allocate for a fixed income, portion of your retirement. Bonds, you could do bonds, you could do REITs. I mean, a lot of people just do growth. I know people, and you do that, too, I bet you guys do. People that just stay in growth, and they just like growth assets. And whenever they need money, they just sell some of their growth assets. I mean, and if they know how to do covered calls, they could generate some dividends most likely without having to sell any of their growth assets. But in any event, that's very common too. There's no one right way to do it, is what I'm saying. And even though I like these and these are good investments, when you allocate money to these, that's money that could have been allocated somewhere else. And maybe for your portfolio, maybe there's something better for your portfolio. I don't know. I do know that in these things, you aren't totally defenseless. These super high yielders, yeah, it is part of the program that the NAV depletes as they pay that dividend out of the NAV, and that dividend is so huge. So there's people that when you reinvest a portion of the dividends back into these funds, it mitigates that damage, or it gives you a lower cost average, a lower average cost. So you take advantage of of what's happening. You keep your costs steady and you just collect the dividend. Most people would just be happy with the fund that they could buy it at $20, it stayed at $20, and just paid a 50% dividend. That'd be a great fund. I would be happy with that. Unfortunately, the funds that pay the super high, 50, 60, 70%, they have to be based on underlines that are way less stable. That's why they pay that much. So those types of funds can be, the NAV part of the investment can be way up in some years and way down in some years. And there's not much you can do about that. That's why I prefer index investing, because indexes can still get killed, but even if an index has a bad year, it might be down 15%. Whereas if a single stock has a bad year, it's down 50%, easy. So in any event. But yeah, be cautious, do your own due diligence, do your own research. If you have any questions, I'm on Discord. I love to talk about the theory of investing. We can talk about this kind of stuff. But the other thing is, you don't have to put the 2/3. I've thought about this a bunch, and Sylvia has verified this. Or she said the same thing, but you don't have to put the 2/3 back in the Defiance. But because you have to be aware that you're kind of cannibalizing some of the principal of your investment in any event. So, but Sylvia said, put in something else. And I've thought that for a long time. That's true. It just has to be in another asset that will hopefully appreciate. That's the whole deal. You don't care. I mean, I like the Defiance one. So I say just buy into them as they go lower, keep your average price consistent, and just keep cashing that check, that big dividend. But I'm saying that's not the only way to do it. You could also use those, knowing that, and just drawing down that account and putting the money from those distributions into another growth asset. If you can pick something, obviously you want something that's going to grow as much as possible. If there's something out there that's better than Defiance, by all means. I just like the systematic thought of being able to buy an ETF, and they're harvesting premium out of the market, and I don't even have to think about that. So I would probably opt for just reinvesting, half to 2/3 back in Defiance, but it's up to you guys. With these funds, they pay you so little, you don't have to do that. forget about that. You just take the money and spend it on these funds. I mean, you know, so we have choices. It's a great time to be a consumer. I'd be anxious to know if any of you guys have these funds, what you think, et cetera, et cetera. You guys have a good day. I'm going to think about maybe taking Jax to, it's too rainy to take to the park, but maybe for a WALK. Jax is pretty smart. He knows English, but he can't spell yet. He's not that smart. All right, guys. You have a good day. Later.